So guys, welcome to VRT Nation. Today we're going to talk about 7 habits of highly effective investors. It's going to be a very interesting video. I will take tons of examples, not just from an Indian perspective, but also from around the world. And once in a while, I will also take examples from my own personal experience so that you can make that real life connection, how a retail investor can be successful. So just a little bit of a background. So I started in the stock market back in 2003 as a trader. Right? So I used to just trade for quite some time. Then at one point of time, I also started gravitating towards investing. Right? So I started reading books. I started analyzing, all the successful investors that we know. I started watching their interviews. And over a period of time, what happened was that I started looking at a pattern. Right? So even though these investors were investing in different markets, in different asset classes, there was some pattern. There was something which is consistent around all these investors, and that is something which I wanted to share in this particular video. So without any further ado, let's get started. So habit number 1 is that successful investors are opportunistic and prepared. Now when we hear about this word opportunistic, we have a little bit of a negative connotation associated with it, right? So let's say, for example, there is a co-worker in your office who you think is opportunistic. You most likely are not going to like that person because you will feel that, okay, this guy is trying to get ahead in life. Using some unfair practices. It's not like, fair. It's not like the right thing to do, right? But in the world of stock market, in the world of investing, being opportunistic is not only desirable, it is actually required. You need to be opportunistic. And the beauty here is that this is not unfair. This is actually fair. This is as fair as it can be. Because in the world of investing in the stock market, everything is a fair game. You're not competing with anybody. You're not competing with any kind of promotion. Everybody gets the same chance. So when the market gives you an opportunity, you need to be able to jump on that opportunity and grab it while you can. And trust me, market gives opportunities all the time, right? So one fine day, Maggi noodles can be found with high level of toxin. And because of that, the stock of one of the biggest FMCG companies around the world becomes available at a bargain prices. Or the CEO of one of the biggest private sector bank can be found engaged in some unfair lending practices, and because of that, the stock of this great company can be found at rock bottom prices. Or of course, the world can be dealing with a pandemic of historic proportions, and you get the whole market, not just one stock, you get the whole market at a fire sale, at a bargain price, right? And here, of course, I'm talking about the COVID crisis, right? So market gives opportunities all the time, but just being opportunistic is not enough. You also have to be prepared, right? So last year, for example, when the COVID crisis was happening, when the market was coming down drastically, I made this video right here, right? I made the video talking about my plans of investing in some very good quality stocks, and I was also advising a lot of people around me that this is a good time to invest. Now, some people, they did not invest because they were afraid that the market would go down further. But a lot of people who were willing to invest at that point of time, they wanted to invest, but they did not have the right kind of capital because their capital was blocked somewhere else. They could not invest as much as they wanted to invest. So being opportunistic is not enough. You also have to be prepared, right? So when you bring this opportunistic mindset and the mindset of being prepared together, it can be a deadly combination, right? And the real life proof of this is this portfolio right here, which I built during the COVID times. And this is my short-term portfolio where I am sitting on a profit of 1 crore rupees. And this is after I have already taken a significant amount of profit from my investments, right? So this is my short-term portfolio. And I have other portfolios where I am making much more money than this. So guys, I'm not trying to show off here. What I'm trying to tell you is that if you want to be successful, you have to be opportunistic and you have to be prepared. Now the habit number 2 is that the successful investors understand the soul of the investment. So let me ask you guys something. Why do we buy gold? Now, most of you would answer that, okay, anything that we are buying, we are expecting it to go up in prices, and at some point of time, we want to make some money, right? That is the ultimate intent of investing. But what if gold goes down 20%? Will you sell it? What if gold goes down 50%? Will you sell it? And I can guarantee you that almost everyone that is watching this video, even if gold goes down 50% from its current value, you will absolutely not sell gold. Now, why is that? Well, because what we need to understand is that every investment has a body and a soul. And this is something very important to understand. See, The body is something that we see from the outside, and in the case of investment, it is the price. Right? So price is what you see from the outside, that's the body of the investment. But the soul is the real reason, the real value that we see in that investment. And as far as gold is concerned, the real value of gold is not in the appreciation, but in retaining its value, and in adverse economic times give us the protection that we need against everything else that is going around us. And that is what successful investors are focusing all the time, the soul of the investment, right? So let me give you a practical example. Let's say, for example, an investor is investing in a stock. So for that stock, the body of that investment is the price that you have to pay. Right? So let's say you're investing in TCS, for example. So TCS, let's say, is trading somewhere around 3,000 bucks. So that is the price that you are paying for that investment. That is the body. But what is the soul of that investment? The soul of the investment of any stock is the actual business. What is the business of TCS? Right? What exactly are they engaged in? What is their profitability? What are their margins? What are their growth prospects? What are their competitors doing? How well is TCS performing with respect to its peers? Right? That is the soul of the investments, and every successful investor is looking at the soul, not the body, right? So we, the retail regular investors, we are very much focused on the price, right? TCS went up 20%, TCS came down 6%, 7%. Successful investors are only and only focused on the soul. How is the business of TCS doing? Are they doing good? Are they not doing good? Are they increasing their revenue? Are they increasing their customer? Are they increasing their profitability? Are they increasing their margin? That is what their focus is all the time, and that is what differentiates them from regular people. Actually, pertaining to that, there is a very interesting quote from Warren Buffett. So Warren Buffett said that, okay, let's say you are buying a stock, right? You buy a stock with the assumption that the day you buy that stock market will be closed for the next 10 years. Right? So you bought the stock, for the next 10 years you will not be able to sell it. If you can live with that investment for the next 10 years, when the market is closed, you will not be able to sell it. Only and only then you should be investing in that company. You see the mindset right there? Warren Buffett is talking about the soul of the investment, which is the business. Is the business solid? Right? If the business is solid, you will not lose your sleep. But if the business is not solid, or if you have not done your research, then of course you will get worried. Right? So that is why understanding the soul of the investment is very important. Now the next habit of successful investors is that they diversify intelligently. So what is diversification? Well, diversification basically means that instead of putting all your eggs in one basket, you are spreading them in different baskets, so that even if something goes wrong with the first basket or the second basket, the rest of the eggs will still be intact, right? In a similar way, when we are investing, if we invest all our money in, let's say, one stock, or let's say majority of our money in one stock, we are always at a big risk that if something goes wrong with that company, then, or with that particular sector, then all your investments will be in jeopardy, right? So a certain level of diversification is very, very important. That's why it's advisable that we diversify across sectors and diversify across different asset classes. But diversification is like putting salt in your food, right? If you put too little of a salt, the food will not taste good. If you put too much of a salt, you will not be able to eat it, right? In the same way, too little of a diversification can cause jeopardy for your investments, but too much of a diversification will also compromise with your long-term returns, right? That is why successful investors, they focus on getting right level of diversification. Now then the question comes, what is the right level of diversification? Is it 10 stocks? Is it 15 stocks? Is it 20 stocks? Or is it 3 mutual funds or 5 mutual funds or 10 mutual funds? Well, the answer to that question is actually very, very simple, and I will give you a thumb rule for that. The level of diversification should be inversely proportional to the level of knowledge, right? So if the level of knowledge that you have is low, the level of diversification that you need is very, very high, because you want to compensate for your ignorance. You want to compensate for the lack of knowledge. And as the level of knowledge starts to go up, the level of diversification should come down, right? And that is why we see that a lot of successful investors, they have very concentrated portfolio. And sometimes, people misunderstand that, right? So people quote to me that, okay, Warren Buffett says that diversification is only for fools, or diversification is just, insurance against ignorance. That is true. But look at Warren Buffett, right? You cannot have the same portfolio as Warren Buffett because he has spent decades and decades understanding the stock market. He has spent decades understanding the soul of the investment that he is investing into. So you cannot have the same kind of portfolio as him, because if you are a beginner, you might want to diversify well. But as you start gaining more and more information, as you start to get deeper and deeper understanding of the market and deeper understanding of the investments and the businesses, then you can bring down the diversification and you can start focusing on specific sectors or specific stocks. Now, the next habit of successful investors is that they have the right kind of patience. Now, this is one advice that you will hear from everybody in the stock market. And every guru out there, they will talk about, okay, have patience, have patience, have patience and patience, right? Buy and just hold, don't worry about the short-term fluctuations, everything will be fine in the long run. But this is a bad advice. Why is it a bad advice? Because it is half truth. And as we know, Ardha Satya, as it is called, half truth is more dangerous than ignorance, right? Why am I saying this? Well, investors of Yes Bank, they were patient, right? They were patient, they were actually a lot patient. What happened to them? Investors of PC Jewelers, what happened to them? Investors of DHFL, what happened to them? Investors of Idea. So I can take literally thousands of examples where investors were told to be patient, and that patience basically only cost them losses. So what we need to understand here is that we have to be patient, but the patience has to be applied at the right place. And that is why successful investors are patient with the body of the investment, but they are impatient with the soul of the investment, right? So in other words, successful investors are patient with the stock prices, but they are impatient with the performance of the business. So let's just break this thing down a little bit. So patience with the price. So what does it mean? Well, first of all, it means that successful investors are very patient to wait for the prices to come to a reasonable valuation before they invest. And that's the first thing. Second thing is, after they are invested in the stock, they do not worry too much about the stock fluctuations. Stocks go up, stocks go down, they are perfectly fine. But what they are not patient with is the business of the investment that they have made, right? So I will give you guys an example. So I was in a conference call, I was listening to the conference call of Lupin, and Rakesh Jhunjhunwala, who is a very influential investor in Lupin, he was grilling the management of Lupin, and you guys will not believe the kind of questions he was asking, right? So the prices were not down at that point of time. Lupin was doing perfectly fine, but he was impatient with the growth prospects of the company, and that is what he was showing in that conference call, his frustration as an investor, why the company was not performing to the right level of expectation that the investors had, right? So you need to break things down. Be patient with the price, but be impatient with the business. If the business is not growing, if their margins are not growing, if they're not expanding, then you need to take a call. But if everything is going fine here, the prices are fluctuating, they're not moving as much enough, you should be patient. Now I will give you guys one more example. So Vijay Kedia, a very influential investor in the Indian market, he bought the stock, and for about 3 to 4 years, the stock did nothing. Right, the stock did nothing, and he had a substantial investment in this particular stock. And every place he used to go, he used to tell people, oh, this is a great company and I'm invested in it. But everybody used to discourage him that, why are you invested in this company? Nothing is happening. Nothing is happening to the price. But he stood by the conviction because he was looking at the soul of his investment, the business performance. The business performance was doing fine, but the prices were not doing fine. But eventually what happened was the stock started moving, and the kind of spectacular move the stock finally happened. The market finally caught up with the business, right? So this is what basically the successful investors do, guys. They are patient with the body of the investment, that is the price, but they are impatient with the soul, that is the business. Now the next habit of successful investors is that they ride their winners. Now let me ask you guys a question. Let's say you have two investments, investment A and investment B. Investment A is giving you a profit of, let's say, 200%, and investment B is giving you a loss of 20%. Now, which of these two investments will you exit first? Right? Now, I know, I'm not sure about you, but majority of people, the way we think is that we would like to come out of the one which is profitable, right? We want to, let's say, book the profit that the investment A is giving, and then we will have some more patience towards this other investment. Hopefully it will recover and we will also make some money from here, right? That is how our common mentality works. And I myself am guilty of doing that. So last year when I was building this portfolio right here, I invested in many stocks, and two of them were Adani Enterprises and RBL Bank. So when Adani Enterprises went up 400%, right? 400%, or I think somewhere around 500%, I booked my profit. I said, this is a good profit, let me just book it. And I came out. And RBL Bank was giving me a loss, and it's still barely up, I think somewhere around 20% up. So I exited from the investment which was working, and I stayed with the investment which was not working. And this is the exact opposite of what successful investors do, because they understand that if something is working, don't mess with it, right? If that investment is already working out, it has already gone up, let's say 200%, 300%, the likelihood of that investment working out in the long run is much higher than the investment which is not working at all. But why are we not able to do that? Because of some psychological issues, right? So sometimes what happens is that we try to be a little bit smart, right? We try to be smart with the market. We think that, okay, if the investment has gone up, let me book the profit, and when the stock will come back down, I will enter again, right? So we start thinking as a trader, and that mentality never works, right? And that is, I would say, is the biggest takeaway here, that if you want to be a successful investor in the long run, you need to be able to ride your winners as long as possible. And speaking of riding your winners, the habit number 6 of successful investors is that they have the stomach for volatility. Now, what is volatility? Well, the volatility basically means that the market goes up, market comes down, market goes up, market comes down, right? And as a retail investor, what happens is that we become very uncomfortable, right? Because we see our portfolio performing to a certain extent. We were up by, let's say, 50%, 60%, and then the market comes down and our investment value goes down to, let's say, 10% or 20%, and that creates stress in our minds, right? And what happens because of all that is that people tend to look for profits, and as soon as they see a certain profit, they tend to come out. But what successful investors do and what they understand is that they are playing a long game. They are not worried about the short-term fluctuations in the stock market, and this is something which you can see across every successful investor, right? See, and you guys should notice this, because what happens is that when the market starts to come down, right, almost every business channel or every business newspaper or article, you will see these kind of articles that Rakesh Jhunjhunwala lost 100 crore rupees in 3 trading sessions, or Warren Buffett lost $80 billion in 3 trading sessions. So what the media is trying to tell us is that, look, these guys are losing so much of money, right? But what is that these successful investors know that we don't know? Well, they know that this happens all the time, right? The market will go up, market will come down. But if you get scared when the market starts to come down and you start to come out of these investments, then you will miss out on the long-term opportunities that the market has to provide, right? So what they develop is a stomach for volatility. And Charlie Munger, who is Warren Buffett's partner, he has said several times that we are very ordinary investors. Our accuracy rate is not that impressive. But what differentiates us from others is the ability to stick to our guns, stick to our conviction. Doesn't matter what the market does, right? And you can see, these guys have been holding some investments for several decades. Rakesh Jhunjhunwala has been holding investments of Titan, holding investments of Lupin, Escorts for several years now, right? And same is the case with other investors. So if you want to make big money in the stock market, you need to develop a stomach for volatility. Now, the habit number 7 is that successful investors follow goal-based investing. Now, this is one habit I will tell you which is more applicable for investors like you and me rather than investors like Buffett and all, right? Because see, we all cannot become Warren Buffett, right? We all cannot become Rakesh Jhunjhunwala. We all cannot become Peter Lynch, right? So we have goals in our life. We are ordinary people. We have goals in our life, and investment is a way to get to the goals. Right? That's what we need to understand. So the successful investor, and this is by the way my own experience being a SEBI registered investment advisor, those investors who have very specific goals in their mind, it can be children's education, or it can be, let's say, building a house, or it can be, let's say, preparing for their retirement. They have specific goals. They have specific amounts that they have in mind that they need to be prepared for that certain date or the year. They tend to do much better than people who invest without a specific goal in mind, right? Because see, the market can go up, market can come down, but your goals have a certain date on which you need to be ready for them, right? For the kids' education, for example, you cannot delay that date. You have to be prepared for that. So successful investors, they plan based on a certain goal. They have a dedicated portfolio for each of these goals, and they invest aggressively or defensively depending on the nature of the goals, right? So if, let's say, it's for your kids' education, you will be more defensive. But if it's for your retirement, you can be a little bit more aggressive because you have a longer period of time. And when they start getting closer and closer to their goals, they start to slowly exit from these investments so that they can put them into some safer instruments so that there is no more volatility, there is no more risk, right? So goal-based investing, guys, a very important concept. I probably should make another video on this topic. It's a very good topic. But that is something you also have to keep in mind. So that is it, guys. I hope that you learned something from this video. We also made a video on 7 habits of highly effective traders. It's a very good video. And if you plan to become a trader, if you have that kind of inclination, you might want to watch that. But on and all, I hope that you will take this advice and apply that in your own life.